Welcome to Talk Tickers. We cut through the noise of earnings calls to give you the crucial information.
And today, we're digging into the first quarter 2025 earnings call for CSX Corporation.
Yeah, and let's just say it was a challenging quarter for them.
Definitely. You saw overall volumes dip slightly, revenue took a bigger hit, and earnings per share, well, that dropped quite a bit.
Right. Though intermodal volumes did nudge up a bit, which is interesting, but management, they're trying to stay optimistic, focusing on, the underlying business and getting these operational problems sorted.
Exactly. So let's break it down. Total volume for Q1 was actually down 1% compared to last year.
Okay.
Merchandise and coal shipments were lower, but that 2% rise in intermodal, mostly from port traffic, helped offset some of that.
Your financials.
Total revenue fell 7%, landing at $3.4 billion. The main culprits were lower benchmark coal prices, those international ones, and less revenue coming in from fuel surcharges.
Which really flows through to the bottom line, right?
Absolutely. Earnings per share ended up down a significant 24%.
Oof. Okay, so volume a bit soft, revenue down more noticeably, really impacting profit. What were the big reasons behind this, operationally speaking?
Well, a huge factor was operational performance itself. CSX ran into some significant hurdles with two massive infrastructure projects.
The Howard Strait Tunnel and the Blue Ridge rebuild?
That's them. They caused a lot of rerouting, which, inevitably leads to delays and network congestion, just slows everything down.
Sounds like a major headache. Big projects always ripple outwards. Was that the only pressure point?
No, unfortunately not. They also got hit by some severe weather events.
Right.
Which just compounded the congestion issues and made recovery slower. So pretty much all their key service metrics suffered. Carload trip plan compliance, that was hit particularly hard.
So internal operational snags were a big piece of the puzzle, not just market stuff. What are they doing right now to fix it?
Their immediate focus is, well, first, getting that backlog of rail cars down. They're also putting more locomotives into the congested areas, bringing in more mechanical staff to keep things running, and even temporarily pausing some capital track work in the worst hit zones.
Just trying to create some breathing room, essentially.
Exactly. Right? Ease the pressure.
And when do they expect us to see, real improvement? What's the timeline?
They're talking about gradual improvement throughout the year. The goal they mentioned is a, quote, significant reset by the third quarter.
U3-3.
Yeah, they're hoping some of the usual seasonal traffic eases up around then, which should help free up capacity.
Okay. Amidst all these challenges, were there any operational bright spots, anything positive?
Yes, actually. Safety-wise, they reported their third straight sequential drop in the FRA injury rate. That's a key federal metric.
That's good.
And they also saw an improvement year over year in the FRA train accident rate. They put that down to their ongoing safety programs.
Definitely good to hear, especially in rail. Okay, let's switch gears to the commercial side. How did the merchandise segment do?
Merchandise saw both revenue and volume dip by 2%. But interestingly, the revenue per unit actually ticked up by 1%.
How'd that work?
It seems their core pricing held up well enough to offset the drag from lower fuel surcharges and what they called a negative mix, meaning like shipping more lower value stuff proportionally.
Got it. So less stuff overall, less fuel money, but better pricing on the core goods moved. How did that play out across different merchandise sectors?
It was definitely a mixed bag. Fertilizer volume was up 2%, but the revenue was flat because of that mix shift.
Okay.
They specifically said they missed out on some grain and food demand because of the operational problems we talked about.
Directly impacted then.
Yeah. Minerals volume was down a bit due to the weather, but they said underlying construction demand seemed strong. Cement volume and revenue were actually up.
Interesting contrast there.
Chemicals revenue edged up 1%, even though volume fell 1%. Plastics and energy demand helped, but weather hurt asphalt shipments.
Okay.
Forest products volume dropped 4%, reflecting some jitters in the building products market. Oils and equipment were sluggish. And automotive, well, that was down too, though they saw things pick up a bit in March.
Wow. It really sounds like those operational issues prevented them from capturing demand that was actually out there in several areas.
That seemed to be a key theme, yeah.
Okay, let's turn to coal. That's always a big piece for CSX. What's the story there?
Coal took a significant hit. Revenue plunged 27%, and volume was down 9%.
Wow. Why such a steep drop?
It was a combination of things. Lower export prices were a big factor, those operational challenges we keep mentioning, and also some specific issues that coal producers themselves were facing. So the overall revenue per unit for coal fell sharply year over year.
What drove the volume drop specifically? Was it just exports?
Exports were definitely down, partly due to some temporary mine outages. Domestic volumes were lower too.
But any positive signs on the domestic side?
They did mention some positive trends from utilities, partly because natural gas prices are higher, making coal more attractive, and they think summer demand could pick up. But on the flip side, demand from steel mills is still pretty soft.
And the outlook for coal prices near term, still looking tough.
They're bracing for a bit more headwind on revenue per unit in Q2. It's mainly due to the lag effect from those Australian benchmark prices feeding into their contracts.
Okay.
They hope that might get partly offset if they can ship more coal to utilities down south.
Right. Okay, moving over to intermodal. You said that was the one area with volume growth. How did revenue look there?
Yeah, volume up 2%, but revenue was actually down 3%.
Huh. So lower revenue per unit then?
Exactly. Mainly due to lower fuel surcharges again, and also because a bigger chunk of their intermodal mix was international shipments, which tend to have different pricing.
And why the pickup in international volume? Any specific reason?
The main driver was more imported containers coming in. Management suggested maybe some shippers were pulling orders forward because of potential tariff changes down the road.
Policy uncertainty driving behavior.
Seems like it. Domestic intermodal, meanwhile, was basically flat.
And what about the trucking market? How does CSX see that impacting intermodal?
Their take is that the trucking market, while not exactly booming, seems to have hit bottom.
So maybe turning a corner?
Potentially.
Yeah.
They see that as, moderately good for intermodal, suggesting rail might look more appealing as trucking conditions stabilize or maybe even tighten up.
Makes sense. Okay, let's look ahead a bit. Future growth. What about their industrial development efforts? Any updates there?
Yeah, this seems to be a real bright spot and a big focus area. They said they're getting a lot of inbound interest from companies wanting to build or expand near their tracks.
Oh, really?
Yeah, the project pipeline is apparently close to 600 opportunities now. And about a quarter of those are already under contract or very close to final site selection.
That's a pretty substantial pipeline. Are these actually starting to turn into business yet?
They are. In Q1, 24 new facilities actually started shipping on their network.
Okay, good start.
And they expect maybe up to 50 more could come online in the next 9 months. So they're definitely banking on this industrial development piece for longer term volume growth.
Right, building that customer base directly on their lines. Let's circle back to the overall financials. Beyond revenue, what hit their operating expenses?
Operating expenses overall were up 2%. A big chunk of that, about $45 million, was directly tied to those network disruptions, the congestion and the bad winter weather.
The direct costs of the operational problems.
Exactly. Plus, just general inflation pressure, though that was partly offset because fuel prices were lower.
Which specific expense lines went up the most?
Labor costs were higher, mostly due to inflation, as headcount was pretty stable. And purchase services costs also rose. About half of that increase was linked directly back to those network and weather issues. The rest was inflation and some other bits and pieces. Depreciation also went up because they have more assets now, and interest expense was higher because of recent debt they took on.
But fuel costs were down, as you mentioned.
Right. Lower prices and some efficiency gains helped there.
They did say they think Q1 was the low point for earnings this year, right? What's the profit outlook for the rest of 2025?
Yeah, they expect a similar drag from commodity prices in Q2, but think that pressure should lessen in the second half.
So sequential improvement.
That's the plan. They're expecting profitability to improve quarter by quarter as they hopefully get the network running more smoothly, find the efficiencies, and improve labor productivity. And their capital spending forecast for the year hasn't changed.
In shareholder returns.
Right.
Still committed despite the tough quarter.
They said yes. They returned nearly $1 billion in Q1 through dividends and buybacks.
Oh.
And they plan to continue what they call a balanced and opportunistic approach, basically weighing shareholder returns against investment needs and, the overall economy.
Got it. So finally, what was the bottom line on their guidance for the full year 2025?
They're still calling for overall volume growth for the full year.
Despite the Q1 dip.
Right. Though they did add a caveat about trade policy uncertainty, making precise forecasts tricky right now. But longer term, they feel well positioned for any expansion in U.S. manufacturing.
Okay.
Revenue-wise, they expect continued pressure from lower commodity prices and mix shifts. But the year-over-year hit from coal prices should ease up later in the year.
And profitability improving sequentially, CapEx unchanged, capital returns balanced.
That's the gist of it, yes.
Okay, quite a detailed picture of a challenging quarter, but one where CSX sees a path forward. That brings us to our This Is Not Financial Advice segment. Time to speculate a little based on what we heard.
All right, let's throw out an idea, maybe looking out towards the end of 2025, maybe into 2026.
Yeah.
Given the operational struggles CSX is working through, but also their expectation that intermodal fluidity will improve and potential shifts favoring East Coast ports. How about this?
Okay, I'm listening.
Consider shorting a major long-haul trucking company. The idea is, if CSX gets its act together operationally, rail intermodal becomes much more competitive, potentially stealing share from trucks on long routes.
And the other side of the trade.
Go long CSX itself. It's a bet that these big infrastructure investments eventually bear fruit, and they can capitalize on those bigger economic trends, like potential reshoring or more domestic manufacturing driven by tariff policies. Basically, infrastructure pain now, gain later.
Interesting pairs trade concept. Got another one. Maybe a bit different.
Okay, maybe something on a slightly shorter time frame, say the next 12 to 18 months. Remember how CSX highlighted strong underlying construction and specifically good cement volumes?
Yeah, contrasted with the weather impact on asphalt and general building product uncertainty.
Exactly. So what about going long on some publicly traded regional cement producers, specifically ones with big operations in CSX's territory, like the Southeast and Midwest?
Betting on continued infrastructure and regional construction strength benefiting them directly.
Right. And maybe, to balance it, consider shorting publicly traded asphalt suppliers. They might face ongoing issues from weather volatility, maybe shifting construction priorities. It leans into that specific strength in cement that CSX pointed out, trying to play that against broader uncertainties.
Definitely some creative, though, as we always say, speculative angles there. And a firm reminder to everyone listening, this is purely for discussion and entertainment, not financial advice. Please do your own thorough research before considering any investment.
Absolutely crucial.
So lots to think about from CSX's quarter. For you listening, what were your main takeaways? What questions pop into your head? Keep digging into the rail sector.
Yeah, the big question lingering for me is just how fast can they really execute on fixing those operational issues? That feels key to unlocking the rest of their potential this year. Definitely something to track.
Indeed. Join us next time on Talk Tickers for another deep dive into the world of earnings calls.